Welcome back to Options Guide, where we focus on real-world strategies that actually work in today's markets. I'm your host, and if you're looking to generate consistent income from your portfolio beyond dividends, you're in the right place. The wheel strategy is perfect for investors who want more control than buy and hold, but less stress than day trading. Be sure to subscribe and tap the bell. We drop new income strategies every week. What is the wheel strategy? The wheel, also known as the triple income strategy, is a repeatable process that cycles through three simple option moves. The goal? Generate income every step of the way, no matter which way the stock moves. Sell a cash-secured put to get paid while waiting to buy a stock at a discount. If assigned, own the stock at a price you're comfortable with. Sell a covered call to collect more premium and possibly sell the stock at a profit. Once the stock is called away, you start over. It's a cycle. That's why it's called the wheel. You either keep the premium or profit from the stock. It's a win-win system for steady income. Step 1. Selling cash-secured puts. This is how the wheel begins. You get paid while waiting to buy a stock you already like. Let's say Apple is trading at $180, and you'd be happy owning it at $175. Instead of placing a limit order, you sell a $175 put for $3 with 30 days to expiration. You collect $300 immediately. One contract equals 100 shares. You also set aside $17,500 in cash. This is why it's called cash secured. Outcome 1. Apple stays above $175. The put expires worthless, and you keep the full $300. Outcome 2. Apple drops to $175. You may or may not get assigned, but you still keep the $300. Outcome 3. Apple drops below $175, say to $170. You're assigned and buy 100 shares at $175, but your effective cost is only $172 thanks to the premium you collected. That's a 1.7% return in 30 days. Annualized, that's over 20%, and you haven't even factored in potential stock gains. Step 2. If the put gets assigned, you now own 100 shares of a stock you already wanted, at a discount. In our Apple example, you were assigned at $175, but with the $3 premium, your true cost basis is $172. Even if Apple trades down to $170, your unrealized loss is only $200, not $500, because the premium cushions your entry. Don't panic if the stock dips temporarily. This is a long-term strategy. You're holding a solid company at a price you chose. Now you move to Step 3. Step 3. You own the stock, and now you sell covered calls to generate more income, and potentially exit the position at a profit. You sell a $180 covered call for $2.50, collecting $250 more in premium. 3 possible outcomes. Apple stays below $180. The call expires worthless. You keep the stock and the $250. Repeat next month. Apple rises above $180. You're assigned, and your shares get sold at $180. Since you bought at $172, that's an $800 gain plus $250 in premium, for a total profit of $1,050 on a $17,200 investment. Apple drops? You hold the stock and keep selling calls each month, reducing your cost basis while waiting for recovery. This step compounds your returns. You're either exiting profitably or earning while waiting. The wheel works best when you choose the right stocks. Here's what to look for. Large-cap companies you'd be happy owning long-term. Stocks with liquid option chains. Moderate volatility. Avoid meme stocks. Neutral to bullish trends. Healthy fundamentals and maybe a dividend. Good wheel candidates include Apple, Microsoft, Google, Johnson & Johnson, and Coca-Cola. If you want more risk, you could consider stocks like Tesla. A few key risk management rules. Don't put more than 5–10% of your portfolio into one stock. Only sell puts at strike prices. You're truly comfortable owning Be patient with stocks that dip below your cost basis. The wheel works best in sideways or bullish markets. If you have a $100,000 portfolio, you might allocate $20,000 across 4 5-wheel stocks for steady, diversified income. Let's walk through a full wheel cycle using Microsoft. Month 1. MSFT at $300. You sell a $290 put for $4. You collect $400 and the stock stays above $290. Profit, $400. Month 2. You sell another $290 put for $3.50. MSFT drops to $285. You're assigned and now own 100 shares at $290. Effective cost, $286.50. Month 3, MSFT recovers to $295. You sell a $300 covered call for $3. MSFT stays below $300. Profit, $300. Month 4, you sell another $300 call for $2.50. MSFT jumps to $305. Your shares get called away at $300. Total premiums collected, $750 puts plus $550 calls equals $1,300. Capital gain, $300. $286.50 equals $1,350. Total profit, $2,650 on a $29,000 investment in 4 months. That's a 9.1% return, or roughly 27% annualized. And now, you start the wheel again with a new cash-secured put. You collect premium, buy quality stocks at discounts, and sell them at profits. The key is consistency, patience, and choosing great companies. If this breakdown helped you, smash that like button and subscribe for more practical income strategies. Drop a comment. Are you planning to try the wheel or have you already used it?